Hey guys, welcome back to our channel. Hope you have a wonderful day. If you guys are new to this channel, we usually talk a lot of things when it comes to
money,
we're,
including personal finance,
Yep.
couple finance, side hustles, investment, micro investment, and now we're trying to be more investor title. Anyway, anything to generate more income to achieve FIRE.
So in today's video, we're going to talk about should you buy a brand new off the plan product or buy an established home. So this is based on our experience.
Just our own opinion.
Yeah, our own opinion and our own experience buying investment property, let's say, not your principal place of home.
Yes, correct.
So from our point of view, you want to go first? Should you buy brand new off the plan for investment property or established home?
For investment, no.
No. Which one would you choose?
Investment, of course, established, because off the plan you have to wait. Yeah, maybe you pay less deposit at that stage, but then you still have to pay something, and then your income not getting generated till it's built with tenant in there. So it may take you 2 years to get your income coming through. And most of the time, whatever they are off the plan, their plan is different to the result. So whatever you think it is, and it may not be what it is eventually.
Yeah, there's an example would be, it could be like say a 3-bedroom.
Yeah, that's one of our friends.
It turned out to be
2-bedroom.
2-bedroom.
Yeah.
And then they said, oh, you expected a balcony.
Yeah.
Turned out to be there's no balcony.
The plan didn't work out.
So.
And you cannot control it. You cannot, because we're talking about apartment, but maybe others, maybe you can if you buy off the plan from a land and build your home. But normally you shouldn't, just for investment purpose, because it will be your kind of residential place of principal place of residence.
Yeah, so for me, like I would not buy brand new for investment property. Purely the fact of that is it will take you at least 12 months to 2 years or so before it can generate an income. Now you're buying brand new, is that for you or is it for the tenant?
Correct.
Tenant would love it.
Very happy, yes.
Yeah, because we've seen a few, I guess, closer friends of ours where they actually moved into a brand new home.
Yep.
And for a tenant point of view, it's like, I got this a bargain because it's only 4 weeks of rental bond. Let's say 6 weeks.
And normally for first year, the rent is quite cheap.
Yeah, to encourage people going in there.
Yes, correct.
And depending on the location as well. You know, for example, like $1 million property, if you're thinking of buying it, let's say 10% deposit, you need to have about $100,000 just on the deposit.
Yeah.
Versus as a tenant going into that $1 million property, let's say
$1,000 a week as rent, so that will be 4,000 bond.
That's it. So maybe with an extra 2 weeks advance, so make it $6,000 that you only need to bring up.
Correct. So that's the planning bit, and like your strategy, what strategy you're trying. And the other main thing is money.
Yeah.
Because one of our friends, they bought off the plan for their principal place to live in. And then they bought it at that price. And once it's built, they evaluate the property. It's way below what they pay for. Okay,
so back to, let's say if it's a number figure, $500,000 property. You know, you agreed on the $500,000 is what the purchase price, because that's what the builder, sold it at.
Yeah.
And then once it's actually being built, and then works out to be the valuation subject to the area, it becomes $480,000 or so.
Yeah.
Valuation come out when the banking coming in, when the finance coming in,
and then they evaluate the suburbs around and what's the sold price. And because it is a kind of new suburb, but then it's with old buildings, so they only can gather data with the older buildings that sold history. So the price, of course, is not reflecting, but the problem is they put, I forgot what was the initial deposit they paid for, but let's say they agree on 20%. At first, they only have to pay 20% of 500, which is 100,000. But then now, because they evaluate less, and the bank only can lend them less money, so which means they have to gather more deposit and cover the loan.
The difference.
Yeah, the
There you go.
difference.
So in that aspect as well, we've seen that happen.
Yeah.
So when you're thinking of buying a property, like for us, we go through, I guess, a second-hand home. Established home.
I'll say yes.
Second,
built already.
yeah.
Built. Yeah.
If you're starting on your, I guess, property investing, I would say don't go on a brand new one.
And there's track record. You know how much it is currently renting or market around there or similar. And another story is some of the builder, they try to give you a guarantee rental.
Oh yeah,
for
guarantee
the first,
rental.
Let's say 3 years, right?
Yes.
Yeah, it sounds so good. But after that 3 years, how about the rental? If everyone is going to drop the rent, you have to drop the rent too.
So I'll give you again another number wise. I guess, what is it? Let's say $300,000 property with a rental guarantee of $300 a week. That sounds really attractive. A rental guarantee of $300 a week.
Yeah.
And then what if after the rental guarantee, a market around the area, it turned out to be only, say, $250 a week, as an example. So that means the true rental is actually $250 a week.
And what if you just been, let's assume, as a usual investor, they just pay interest only on the loan, which means you're still paying at the price you bought it in. You didn't pay down the principal amount of that property.
Yeah.
And if your rent is going down to 50, cannot cover your mortgage, cannot cover your interest, and at any circumstance that you cannot pay it off from your income, you have to sell.
Yeah,
you
so
have
that
to sell
gives
the
you
property.
It's a forced sale due to financial circumstances, and that's not a good feeling if you have to do that.
Yeah, being forced to sell
For
property.
Yeah, because that we experienced that at one stage. We have to force to sell due to financial circumstances, and that's not fun.
It's very stressful.
Yeah.
Yeah.
And it could ruin your relationship. You have sleepless night. The stress level gets really high because every week you have to come up with that
mortgage repayment.
Yeah, you're thinking in the back of your head, it's like, okay, how much do I have to save up, or how much do I have to make every week in order to keep this afloat?
Yeah.
So it can be frustrating, property investing, but it can be a blessing.
Yes.
So
if it's working out.
Correct. So I guess in a sense, look at the numbers really, really carefully. How can we avoid it? Like,
avoid what?
How can we avoid, in a sense of, okay, what do we have to do if we were to do it again?
Pay more deposit.
Pay more deposit.
20% as a minimum. Do not pay lender mortgage insurance if you can. One, your mortgage amount number will be smaller.
Yep.
And then two, your repayment will be less. And three, pay principal and interest together. Don't just pay interest.
If you're paying interest only, you're actually making the bank richer.
Yeah, that's what the bank likes.
Yeah, the bank like it when you do interest only component, because at the end of whatever term it is, you still owe them that
the same
big lump
amount.
sum.
Yes, and they're getting fixed income from you every single week or month based on your repayment.
Yeah, so
pay down principal and interest, and also pay off your loan as quickly as you can.
So we're in that lifestyle now where we actually try to chip in our mortgage as quickly as possible. After paying off the first mortgage on our investment property, it kind of feels good, and realize no, all of the strategies that we've been following is kind of wrong.
It is not suitable for us. It's not wrong. I'll say it's not suitable for us.
Yeah, actually.
It is, talk to your accountant. Accountant won't agree with our opinion, trust me, because in tax purposes, it's not working out. But accountant only look at how much tax you should minimize your tax, but they're not looking into your stress level, not looking into your marriage, not looking into your relationship.
Your lifestyle, what are you trying to achieve?
If you're arguing based on numbers, no, it's not working out. But we're just doing it as our insanity, and we just want to have a more relaxing lifestyle.
like looking at I guess a few news so far recently anyway, there's a lot of developers out there that is actually going bust
in Australia.
And these are not your small developers, these are your big like national developers. I mean, you can only limit like how many developers that you can trust, but at the end of the day, you still taking the risk of you still required to build that property. What if the risk of, let's say,
they're going bankrupt
and they cannot complete
took your money, they took your hard working sweat money at deposit, and then they go busted.
Let's
and
say
then
you
pay 10% of like a $500,000 house, $50,000 gone.
And then if they go bust, so that means you gotta have the headache of finding another developer, and then finding, it's already stressful enough just to manage the cash flow of it, let alone like figuring out the nuts and bolts of developing. So as a rookie or as a first time investor, probably would not do it as the I guess the first transaction that you do as a buy dirt to house.
Yes. Yeah.
So that's just our 2 cents, by the way. Like, I could be wrong. Based on our experience so far, definitely established home versus building your own.
Yes, correct.
So anyway, that's just our 2 cents. Like I said, if you like this type of content, don't forget to subscribe, comment.
See you next time.
Bye.